masterclass. And tonight we're going to listen to Crystal talk about her final presentation, her final work and project, where she's going to present the valuation of the company Kroger. Crystal, are you ready to go?
Yeah.
I'm excited. So let me bring up your presentation here. And now we can see your presentation. Can you go up and down just to make sure you've got control? Perfect. All right. That's working. Okay, so I'm going to leave the scene and you're going to take over. Are you ready?
Yeah.
I am leaving now. Go for it.
Hi everyone, I'm Crystal, and today I'll bring you through my analysis of Kroger, where I initiate a coverage on Kroger with a sell recommendation based on a target price of $47 USD, implying a downside of 13.6%. I derive my target price based on a DCF-based valuation using a WACC of 8.1% and a terminal growth rate of 2%. Three key highlights which I'll be going through is the US maturing grocery market challenging domestic growth prospects, the private label brands driving future revenue growth, as well as e-commerce expansion driving future growth. The four main risks that I'll be going through is that the growth potential may be limited by the maturing market, intense competition from online and offline competitors, regulatory challenges may affect companies' growth, inflation and rising commodity prices threatening low-cost price differentiation. So firstly, let's dive into the background of Kroger. Kroger was founded in 1883 and operates over 2,722 stores in 35 states throughout the US. The company operates mainly in supermarkets, fuel centers, pharmacies, and convenience stores. Kroger holds a market share of 10% in the grocery retail sector, and its main revenue comes from retail sales at its supermarket and multi-department stores. The US maturing grocery market is challenging domestic growth prospects of Kroger. In 2019 to 2023, the US grocery market saw a 5.6% growth rate. However, the market's growth has slowed, and the grocery sales is expected to grow at a CAGR of 1.6% from 2024 to 2028 due to market saturation and a competitive landscape. Furthermore, the US population growth rate is projected to slow down with 0.6% at 2024 to 2034 to 0.2% from 2045 to 2054. With this, Kroger will likely face limited expansion opportunities and a potential decrease in revenue. Secondly, private label brands are driving future revenue growth of Kroger. The sales of private label food and beverages have increased by 7% in 2023, and more than 90% of Kroger customers are purchasing its private label brands. With the introduction of new additions to its private label brands, I anticipate that it will drive sales and profitability, boosting Kroger's share of sales. Lastly, e-commerce expansion drives future revenue growth. Kroger is transforming its operation, and Kroger's e-commerce sale grew 10 times the rate of its total sales and had a 33% improvement in perfect orders. Kroger also aims to enhance its partnership with Ocado to implement technological developments which will reduce overhead costs, boosting customer satisfaction, and overall, driving a significant growth in its revenue and market share. Now moving on to the industry analysis, we can see that Costco and Walmart dominates the sector, and the industry is a growing industry with changing consumer demands disrupting major players. The industry can be broken down into four main categories: the drug retail, food distributors, food retail, and hypermarkets, and the sector holds a market cap of $1.7 trillion. The US dominates the industry's retail market given its large customer base with higher per capita income, and it is expected that the sector reaches a market value of $2.6 trillion in 2031 with a CAGR of 7%. With a shift in consumer preferences towards e-commerce, major players may see a disruption in their physical retail stores as e-commerce companies continues to grow. Health and wellness trends are also leading growth in the industry, as the shift in rising health consciousness preferences in consumers has led to an increase in demand for organic and natural products. The global organic food market size accounted for $228 billion in 2024 and is expected to reach $658 billion in 2034, with a CAGR of 11%. Lastly, e-commerce is shaping the growth of the food and staples retailing sector. The global e-commerce market is expected to grow from $18 trillion in 2024 to $67 trillion in 2033, with a CAGR of 15%. And technology has also led to a 19% growth in Costco's e-commerce sales. Now, moving on, we can see that in the second quarter of 2025, Kroger experienced a slight revenue increase of 0.2% year-on-year, and the company saw a 3.6% year-on-year increase in gross profit margin, and EBIT margin decrease in the second quarter of 2025. Recently, Kroger has announced plans to acquire Albertsons in 2022. However, the company is currently facing regulatory complications as the Federal Trade Commission sued to block the merger. Kroger has also placed order for a wide range of automated technologies to improve customer experience and company efficiency, and this also further drives its growth in the e-commerce sector. Now, looking at the consensus estimates, we can see that over 40% of analysts hold a neutral view on Kroger, and 12 analysts have issued a buy recommendation. The mean target price indicates a potential 6.5% upside, and consensus also predict a slight decrease in its revenue growth from 1% in 2024 to -1% in 2025. Now we see Kroger's revenue structure, which is mainly driven by the retail sale of its products. Approximately 50% of their supermarkets were operated in company-owned facilities, with its largest revenue segment being the non-perishable goods, accounting for 51% of its revenue. Secondly, another significant contributor is fresh goods. Another significant contributor is fresh goods, accounting for 24% of Kroger's revenue. And Kroger owns 33 food production plants with 14 dairies and 9 dairy or bakery plants. Thirdly, supermarket fuel sales contributed to 11% of its revenue stream, and the pharmacy segment also plays a critical role, contributing to 10% of its revenue. Lastly, Kroger also diversifies its revenue through smaller segments, which makes up 4% of its total revenue. Now, looking at the four elements, Kroger appears attractive relative to 1,810 non-financial companies in the US, considering fundamentals, valuation, momentum, and risk. In terms of fundamentals, Kroger is ranked as the best due to its strong asset turnover. However, looking at the risk, Kroger is ranked in the top 30%, with the net debt to equity ratio increasing. Price risk measured in terms of beta to the US market is lower than their other companies in the benchmark, standing at 0.2. Looking at Kroger's profitable growth, it ranks the bottom 40% among 540 large consumer staples. And Kroger's asset efficiency has been a big positive, where it consistently shown world-class performance and supported the main driver of the overall profitable growth rank. However, Kroger's expense control has ranked 9 and offset the great asset efficiency. Looking at Kroger's profit and loss statement, we can see that the revenue is forecasted to grow consistently, as the EBIT margin is also growing throughout. Looking at its asset, the net fixed asset is forecasted to grow due to their investment in technology. Looking at its liabilities and equity, we can see that the long-term debt is going down as companies has sufficient cash. And the cash flow statement shows the capex increasing, and the investing cash flow is also increasing as the company is investing in tech to drive their growth. Looking at the ratios of Kroger, we can see that the current ratio is relatively stable from 2022 to 2027. And for the free cash flow data, we can see that EBIT is growing and the capex is also increasing as well. Now, looking at Kroger's relative valuation, on the forward 2026 PB multiple, Kroger looks cheaper compared to its competitors, and this results in Kroger trading at a significant discount based on the 2026 PB to ROE multiple, which shows that it is highly undervalued. On the forward 2026 PE multiple, however, Kroger trades at a significant discount, and Kroger seems cheap on a PE basis, trading at a PE of 9 times. I expect its EPS growth to be higher than the US, Asia ex-Japan, and the world in 2025, but low in 2026. And this results in Kroger trading at a significant premium based on the 2026 PE to EPS multiple compared to the US, Asia, and the world. Moving on to valuation and target price, I assume a risk-free rate of 3.5% and a market equity risk premium of 8%. Since Kroger is a low beta stock, I assume a beta of 0.75 times. And I forecast a capital structure with around 20% debt to total capital, which results in a WACC and a discount rate of 8.1%. I use a terminal growth rate of 2% and free cash flow to the firm to value Kroger. In my base case scenario, I anticipate a gross margin of 22.3%, leading to a value of $47 per share based on the FCFF methodology. In my sensitivity analysis, the optimistic case assumes a gross margin of 24.3%, leading to a valuation of $70. On the other hand, the pessimistic case assumes a 20.3% gross margin, leading to a FCFF of $24. Now, looking at Kroger's risk, Kroger's main risk is market saturation and intense competition. Kroger's growth potential may be limited by a maturing market, as it heavily depends on its traditional retail stores. Given the maturing and saturated market in the US, Kroger may reach a point where its growth will remain stagnant or even decline. Secondly, the intense competition from online and offline competitors such as Walmart, Costco, Target, as well as online retailers like Amazon. With more retailers seeking to lower prices to capture consumers, this may also result in price wars for Kroger. And eventually, they will need to lower their prices to remain competitive, leading to a decrease in profitability margins. Legal and regulatory challenges may also affect Kroger's growth. Kroger, facing legal and regulatory challenges currently, has already spent $535 million on merger-related fees. These regulatory hurdles could potentially affect Kroger's competitive position in the market and shift its focus away from company development, slowing down its growth potential. Lastly, inflation and rising costs are threatening Kroger's low-cost price differentiation model, and they may face challenges keeping up with its own model. Eventually, if this continues, it will lead to reduced earnings and worsening downside risk in its stock price. With that, I've just went through why I believe that Kroger is currently overvalued, and hence I initiate a coverage on Kroger with a sell recommendation based on a target price of $47 USD, implying a downside of 13.6%. Thank you.
$535 million they've already spent related to the merger. That's incredible amount of money.
Yeah.
And what one of the questions that we're getting is, related to what's going on with the merger and how does the merger, whether it happens or doesn't happen, how does that affect Kroger?
I think that currently, because Kroger will spend around $25 billion to acquire Albertsons if the merger happens, and they have already spent a large amount of money on merger-related fees as well. If the merger goes along, Kroger's stock price will likely not face a huge increase or decrease due to the fees that they have already spent so far. And after the merger, based on the company that they are acquiring will also kind of offset what they have already spent and what they are going to spend in the future.
And why are they doing this merger? What is it that they get from this?
Kroger believes that this merger will actually allow it to expand its market share and compete with the larger competitors such as Walmart and Costco, which are dominating the market as we can see. So I believe that this is why Kroger aims to go through with the merger.
Okay. We got a question from Sharon. She said, what are the key reasons to your sell recommendations? I see revenue and EBIT growing year on year. Why are you negative?
Definitely, with the revenue and the EBIT growing, I still recommend a sell recommendation because I believe that as mentioned, the US market is actually facing saturation as well as maturity. So a lot of investors are actually very optimistic about Kroger's growth. However, I believe that there may be a point where Kroger will face limited growth rate because of maturity, and eventually they will face a decline in revenue when they hit maturity. So that is why I have a sell recommendation for Kroger.
And another question is, what would it take for you to come up with a buy? Is there something that obviously if the share price dropped a lot, you could potentially say it's worth getting into? Is there anything fundamentally that would give you some positive, feeling?
I think what I believe that will be the most positive currently is Kroger's investment in its private label brands. I think they are partnering with a lot of people and coming up with a lot of private label brands to curb the change in consumer demands, and that might be one of the possible reasons that when its share price drop drastically may allow Kroger to see its future growth potential if it continues with R&D in this area.
And what about Moman asked about international expansion? Are there plans, and if not, or if there is, what are your thoughts on that?
I don't think there are in much plans for international expansion. I think now they are also mainly focusing on the merger. And I believe that Kroger can actually venture out of the US to get a better ground outside and improve their growth potential in markets that are emerging and markets that do not face as much of a saturation as the US.
So how does it feel to graduate from the Valuation Masterclass Bootcamp?
It feels great. I think definitely it wasn't easy going through this boot camp, and it definitely feels great to be able to give the live presentation and to be able to graduate. Yeah.
Yeah, you did a great job. What is the transformation that you went through in the bootcamp?
I think for myself, I didn't have much experience valuing a company, even though I may have learned the knowledge. But I think through this bootcamp, I definitely became much more confident in valuing a company. I think I am now able to really dive into what the company says and not believe what the CEO says, and really dive into the background of it.
You remember when I said, believe nothing, believe no one, demand evidence? I
Yeah,
said that on the first night, I think it was.
yeah,
And I think some people are like, what? But now you see what I'm saying.
yeah.
Fantastic. Well, I'm going to take you out of this and then I'll talk to you in just a second.
All right.
All
Thank
right.
you.
Well, now we've got the story on Kroger. We've looked at Albertson, Kroger. That was a great presentation and really impressive. So I'm excited. So if you want to build a competitive advantage in company valuation, why don't you join us in the Valuation Masterclass?